Taxes and other forms of exactions in the Philippine taxation. In Philippine taxation, taxes are just one form of government exaction, a broader category that includes various compulsory charges imposed by the state or the authorized entities. Here's a breakdown of taxes and other forms of exactions along with their distinctions. Taxes. Taxes are compulsory contributions imposed by the government to raise revenue for public purpose. They are inherent to the state's sovereignty, legislative in nature, only Congress can impose them, subject to constitutional limits. Well, there is due process, equal protection, and public purpose, and is used for revenue generation, regulation, and redistribution of wealth and economic development. There are two types of taxes in the Philippines. We have the national taxes, which include the income tax, VAT, excise tax, estate tax, donors tax, and custom duties. And then we have local taxes, which include real property tax, business tax, community tax, and other local fees. Other forms of exaction. These are charges or levies that may resemble taxes but differ in purpose, authority, and legal basis. Key distinctions include tariffs and custom duties. These are imposed on imported and or exported goods. It is a form of tax but is specifically tied to international trade. Tolls. These are charged for the use of public infrastructures such as roads, bridges, based on proprietorship and not sovereignty, and can be imposed by private entities or the government. Licenses and regulatory fees. These are imposed under the police power of the state. Purpose is regulation, not revenue, must be commensurate with the cost of regulation, and failure to pay makes the activity illegal. Special assessment. These are levied only on landowners who benefit from public improvement. This is based on benefits received, not general revenue needs, and it is not a personal liability but is tied to the property. Penalties are the sanctions for violating laws, may be monetary, but are punitive, not revenue generating, and can be imposed by government or private entities. Next is debt. These are based on contracts, not law, can be assigned, paid in kind, and subject to set-off. It is also not considered a form of taxation. Why the distinction matters. Understanding whether a charge is a tax or another form of exaction affects the legal remedies available to taxpayers. Exemption, the constitutional protections, and the regulatory oversights and judicial review. Requisites of a valid tax. Number one, public purpose. Taxes must be imposed for a public purpose, meaning the revenue collected should benefit the general public, such as infrastructure, education, health, or even defense. This principle is rooted in the idea that taxation is a tool for promoting the common good, not private interest. Uniformity and equality. Taxation must be uniform and equitable within the same class of taxpayers. Uniformity means equal treatment for those similarly situated. Equality allows for reasonable classification, such as corporate versus individual taxpayers, as long as they are based on substantial distinctions. Legislative imposition. Taxes must be imposed by law, specifically by Congress or authorized local legislative bodies. The power to tax is non-delegable, but Congress may delegate the implementation details to administrative agencies like the BIR or the Bureau of Internal Revenue, provided clear standards are set, compliance with due process and equal protection. Tax laws must be reasonable, not arbitrary or oppressive. Taxpayers must given notice and opportunity to be heard. Classifications in tax laws must be rational and serve legitimate government objectives. Territorial jurisdiction. The person or property being taxed must be within the jurisdiction of the taxing authority. This ensures that the government does not overreach its authority. And adherence to constitutional and inherent limitations. Taxes must respect non-impairment of contracts, prohibition against unjust double taxation, progressive taxation, fiscal adequacy, and administrative feasibility. Characteristics of taxes. 1. Enforced contribution. Taxes are not voluntary. They are imposed by law and collected by the government regardless of the taxpayer's consent. The obligation to pay arises from the sovereign power of the state, not from any contract or agreement. Levied by law. Only the legislative body, which is the Congress or the local legislative councils, has the authority to impose taxes. The executive branch, that is the BIR or LGUs, handles the assessment, collection, but cannot create new taxes. Levied for public purpose. Taxes must be used to fund government operations and public services such as infrastructure, education, health, and defense. They cannot be used for private gain or benefit. Generally payable in money. Taxes are usually paid in cash, although the government may resort to restraint or levy, seizing property, no, if the taxpayer fails to pay. They are also proportional in character. Tax burdens should be based on the taxpayer's ability to pay. This principle supports progressive taxation where higher income earners pay more. And territorial. Taxes are imposed only on persons, properties, and activities within the jurisdiction of the Philippine government. They are also subject to constitutional and inherent limitations. Taxes must respect due process, equal protection, uniformity, and equity, non-delegation of taxing power, and public purpose requirement. Regular and periodic. Taxes are typically collected on a regular basis, such as monthly, quarterly, or annually, depending on the type of tax. Administrative feasibility. The tax system should be easy to administer, cost-effective, and convenient for both the government and the taxpayers. And last, the lifeblood doctrine. Taxes are considered the lifeblood of the government, essential for its survival and ability to serve the public. Classification of taxes. Number one, based on authority imposing the tax. We have national taxes. These are imposed by the national government through the Bureau of Internal Revenue, governed by the National Internal Revenue Code, such as income tax, no, value added tax, excise tax, estate tax, and donors tax, and the documentary tax. Local taxes. These are imposed by the local government units, no, under the local government code. This includes real property tax, business tax, community tax, and amusement tax. Based on method of collection, we have direct tax. No? These are paid directly by the taxpayers to the government and cannot be shifted to another person. This includes income tax, estate tax, donors tax. and real property tax. Indirect tax, on the other hand, are paid by one person but passed on to another, usually their customers. These include value added tax, excise tax, and percentage tax. Based on purpose, revenue taxes. This is a collected primary purpose is to raise funds for government operations, and most taxes fall under this category. Regulatory tax, imposed to regulate behavior or discourage certain activities. This includes excise tax on alcohol and tobacco and environmental taxes. Based on subject matter, we have income tax. No? These are levied on earnings from employment, business, and investment. These include individual income tax, corporate income tax, and capital gains tax. Property tax, on the other hand, is levied on ownership or transfer of property. These include real property tax, estate tax, and donors tax. Consumption tax, on the other hand, is levied on spending or use of goods or service. Okay? This includes VAT, excise tax, and percentage tax. Transaction tax. These are levied on specific transactions. This includes VAT, excise tax, and percentage tax. Based on graduation, graduated taxes. These are taxes where the rate increases as the taxable base increases, commonly applied to income taxes and reflects the principle of ability to pay, wherein higher earners pay more. This is an example of an individual income tax under the train law. This is a progressive taxation. No? Proportional taxes, no? Or flat taxes. The same rate is applied regardless of the amount or value. Easier to compute and administer, and is often used for percentage taxes, documentary stamp taxes, and some local taxes. Samples are percentage tax, like 3% of gross quarterly sales, receipts for non-VAT taxpayers. Also for 8% flat income tax, no, which is optional, no, for self-employed individuals and professionals with gross income not exceeding 3 million. Regressive taxes. The effective tax rate decreases as the taxable base increases. No? Well, this is not common in the Philippine law but can occur in consumption taxes like VAT or excise tax, where lower income individuals bear a heavier burden relative to their income. This is a summary table of graduated, no, rate increases with the income or value. Example of this is yung income tax. Proportional or flat, fixed rate regardless of amount. Example is percentage tax or the 8% flat tax. Regressive, rate decreases as income or value increases. Example niyan is VAT, no, in effect, and excise tax. Is based on how the amount is determined. We have a specific tax. A tax imposed based on a physical unit or measurement such as volume, weight, or quantity. Amount is fixed per unit, no, regardless of the price of the item. Example is excise tax on cigarettes, which is 50 pesos per pack, and excise tax on alcohol, which is 45 pesos per liter. Advantage is it is easy to compute and administer and is a stable revenue regardless of um, price fluctuations. Disadvantage is does not adjust to inflation or market price changes. Ad valorem tax. This is a tax imposed based on the value or selling price of the item. It is percentage based, meaning the tax increases as the price increases. Example is excise tax on automobile, which is 10% to 50% depending on the value. Another one is excise tax on jewelry, which is 20% of the selling price. The advantage is it is responsive to the market changes and more equitable in luxury goods taxation. However, it requires accurate valuation and is more complex to administer. Next is mixed tax. This is a combination of a specific and ad valorem component, used when both quantity and value are relevant for taxation. Well, these are used for some petroleum products which may be taxed both per liter and as a percentage tax. Advantages is balances simplicity and responsiveness and can be tailored to different policy goals. Tariffs and custom duties in the Philippines. Tariff is a tax imposed on imported goods. No? It serves two main purposes: revenue generation for the government and protection of local industries by making imported goods more expensive. Custom duties, on the other hand, are taxes levied on goods when they cross international borders, either entering import duties or leaving export duties the Philippines. No? They are assessed by the Bureau of Customs. Types of import duties in the Philippines. We have ordinary import duties. They are usually ad valorem and is based on the value of the goods. Rate ranges from 0 to 65% depending on the product and origin, and is governed by the tariff and custom codes of the Philippines. We also have special duties. These are additional duties imposed under specific conditions. Number one is the anti-dumping duty. This protects the local industries from foreign goods sold below their fair market value. We also have countervailing duties. These are imposed on subsidized imports that harm domestic producers. Marking duty is a 5% ad valorem, no, tax if imported goods are not properly labeled with the country of their origin. Discriminatory duty up to 100%, no, ad valorem on goods from countries that discriminate against Philippine exports. And the last one is the safeguard measures. These are temporary duties to protect local industries from import surges. Duty rates and trade agreements. MFN, or most favored nations, these are non-ASEAN countries which are charged custom duties ranging from 0 to 30%. And then we have ASEAN Trade in Goods Agreement, or ATIGA. These are ASEAN countries where their goods, no, enter the Philippines duty free. And then we have special exemptions which apply to for humanitarian aid, medical supplies, and goods under specific trade agreements. Compliance and documentation. To import goods legally, businesses must submit import permits, commercial invoices, bills of lading, and certificates of origin. Failure to comply can result in penalties, delays, or seizure of goods. Licenses and regulatory fees. This refers to charges imposed by the government agencies, such as national or local, for the authorization to engage in certain activities or to access specific public services. These are not taxes but user charges or regulatory levies collected in the exercise of the government's regulatory and service delivery function. This includes business permits, professional licenses, registration and accreditation fees, environmental compliance certificates, medical and laboratory examination fees, and franchise and concession fees for public utilities. Legal and tax treatment. According to the Supreme Court, regulatory fees are not considered taxes because they are tied to the cost of regulation or service delivery and not as a general revenue collection. The Bureau of Internal Revenue classifies costs associated with licenses, franchises, and concessions as administrative costs and not direct costs of service. This affects how businesses compute their optional standard deduction for income tax purposes. Purpose of imposing fees for efficient resource management. This helps reduce government spending while maintaining the service quality. Cost recovery ensures that the government recoups the cost of providing service, while regulatory oversight ensures that compliance with laws and standards. And the last one is market access control. This grants legal permission to operate in regulated sectors. Okay? Key criteria for imposing licenses and regulatory purpose. Number one is purpose. The fee must relate to an occupation or activity that affects health, morals, safety, or public welfare. It must be imposed to regulate such activities for the protection and promotion of public interest. This is cost-based justification. The amount charged must bear a reasonable relation to the cost of regulation, including both direct and incidental expenses. LGUs or local government units are required to ensure that fees are commensurate to the cost of service or regulation, not based on capital investment or gross sales. Legal authority. Fees must be authorized by a duly enacted local ordinance or national law. Regulatory fees may be imposed under both the police power and taxation power, but the primary basis should be regulatory. Non-overlap with professional regulation. LGUs cannot impose fees that regulate the practice of profession, as this is under the jurisdiction of professional regulatory boards, the PRC, no, for licensed professionals. Professionals must still secure business permits, but these should be free of charge if the activity is purely professional practice. And then, of course, we have special cases. If a professional engages in commercial activities such as selling goods, LGUs may impose business taxes and permits. Multiple professions require separate license fees for each practice. The Supreme Court has clarified that regulatory fees are valid if they are not excessive and are used to cover the cost of the regulation, and they must not be disguised as taxes intended for revenue generation. Special assessment in the Philippines. In the Philippines, a special assessment, also called a special levy, is a charge imposed by the government on the landowners whose properties benefit from a public infrastructure project. It is distinct from regular taxes and is governed by the Local Government Code of 1991. A special assessment is a levy imposed on the land adjacent to a public improvement, intended to cover part of the cost of that improvement. It is not a general tax, but a contribution from property owners who directly benefit from a specific government project such as road widening, drainage systems, street lighting, and sidewalk construction. This is a summary, no, of the key features of special assessment. Who imposes it? No? Well, the local government units. And who pays? The owner of lands adjacent to or benefiting from the public improvement. Basis of computation is based on the assessed value of the land and extent, no, of benefit received. Collection method, usually in installments with interest if unpaid, and strictly for the specific project or which the assessment was levied. Toll in the Philippines. According to the Department of Finance, a toll is the money received from users of the toll expressway system as payment for the use of the system. Purposes of toll fees is to fund, no, the construction, maintenance, and operation of the infrastructure. It also allows private concessionaires or government agencies to recover investment costs and to regulate traffic and promote efficient use of the road. Taxation of toll fees. Although tolls are not taxes, tollway operators are subject to taxation. Number one is local business tax. LGUs may impose business taxes on tollway operators based on gross receipts collected at toll plazas within their jurisdiction. Value-added tax. The Supreme Court upheld that toll fees are subject to VAT under Section 108 of the National Internal Revenue Code as they are considered as a sale of service. Here is a table differentiating tolls versus taxes. The nature of toll is voluntary fee for using a facility, while tax is mandatory charge imposed by law. Purpose: toll is used to recover the cost for infrastructure, while tax is used, no, for revenue generation for public service. Toll is imposed by tollway operators or government agencies, while tax are imposed by the national or the local government unit. Example of tolls are the NLEX or the North Luzon Expressway, XLEX or the South Luzon Expressway, and the Skyway tolls. While tax, the samples are income tax, VAT, and real property tax. No? Penalty. In the Philippine taxation, a penalty refers to the additional charges imposed on taxpayers for violation of tax laws such as late filing, underpayment, or non-compliance. These penalties are meant to encourage voluntary compliance and deter tax evasion. Types of tax penalties. Number one is surcharge. This is 25% of the basic tax due for late filing or payment, filing in the wrong district, and failure to pay the full tax due. 50% surcharge applies in cases of willful neglect to file and filing a false or fraudulent return. Interest, on the other hand, is a 12% per annum, or previously 20% now, on unpaid taxes calculated from the due date until full payment. Types of interest. We have deficiency interest, which is a charge, no, on underpaid taxes discovered during audit. Delinquency interest. These are penalties on taxes not paid by the due date. No? while extended payment interest is considered when payment or installment payments are missed. Compromise penalty. This is a fixed amount paid to settle minor violations without going to court. Ranges from 200 to 50,000 depending on the amount of unpaid tax. Sample is a 1,000 peso for unpaid tax below 5,000, 50,000 for unpaid taxes over 50 million. Legal basis. Penalties are governed by Section 248 to 249 of the National Internal Revenue Code. The Ease of Paying Taxes Act, or RA 119076, introduced reduced penalties for micro and small taxpayers starting in 2024. Instead of being charged 25%, they are now charged 10%. 6% interest is charged instead of the 12%, and lower compromise penalties, which is 500 pesos per violation, capped at 12,500 annually. Tax deductibility of penalties. Surcharges and compromise penalties paid to the government are not deductible from taxable income under Section 34A and C of the National Internal Revenue Code, while interest on tax deficiencies may be deductible as a business expense under certain conditions. Impact on taxpayers. Penalties can significantly increase the total amount payable. Example, a 20,000 tax liability paid 3 years late could result in 21,000 in penalties, totaling of 41,000. Compared to neighboring countries like Singapore and Malaysia, Philippine penalties are higher and more complex. Debt payment in the Philippines. In the Philippine taxation, the obligation to pay debt refers to the legal duty of a taxpayer or a debtor to fulfill his or her financial liabilities, including taxes. In accordance with the law, this concept is rooted in both the Civil Code and the National Internal Revenue Code. Legal basis of debt payment obligation. Under Article 1156 of the Civil Code, an obligation is a juridical necessity to give, to do, or not to do. In the context of taxation, this means that taxpayers are legally bound to pay taxes and settle any tax-related debt once they become due and demandable. Key principles of debt payments in taxation. Payment must be complete and proper. The debt must be paid in full unless partial payment is expressly allowed. Payment must be made in Philippine legal tender, such as cash or coins issued by the Bangko Sentral ng Pilipinas. Checks or digital transfers are not considered payment until encashed or accepted without protest. Who can pay? The debtor or the taxpayers themselves, a third party with the debtor's consent, or who may seek reimbursement, or a third party without consent, valid only to the extent the debtors benefit. To whom payment must be made? To the Bureau of Internal Revenue or its authorized agents, or payment to unauthorized person is generally invalid unless ratified. Time and place of payment, as stipulated in the tax law or regulations, or if unspecified, payment is made at the debtor's domicile when the obligation becomes due. Consequences of non-payment. Of course, there are penalties and interest under sections 248 to 249 of the NIRC. It could also result to legal actions including disdain, levy and garnishment, loss of access to government service and permits, and damage to credibility during audits and compliance checks. This is a summary of tax debt versus private debt, no, settlement. No. Set-off or compensation in the Philippines. In the Philippine taxation, set-off or compensation is strictly prohibited in cases of tax delinquency. This principle is rooted in the lifeblood doctrine, which emphasizes the essential role of taxes in sustaining government operations and public welfare. No set-off or compensation for tax delinquency. Taxpayers cannot offset their tax liabilities even if delinquent with any claims they may have against the government. This means a taxpayer cannot refuse to pay taxes on the ground that the government owes them money. Tax delinquency must be settled in full, regardless of any pending government obligation to the taxpayer. Legal and jurisprudential basis. Civil Code Article 1278. Compensation is allowed only when two parties are mutually creditors and debtors. In taxation, the government acts in its sovereign capacity, not as a commercial debtor. Supreme Court ruling. United Airlines versus the Commissioner of Internal Revenue. Taxes are not debts that can be offset. The government and taxpayers are not mutual debtors. Caltex versus the Commission on Audit. Tax collection cannot be delayed by lawsuits or claims against the government. Lifeblood doctrine. Taxes are the lifeblood of the government and must be collected promptly. Allowing set-off would undermine revenue collection and disrupt public services. Escape from taxation. These are the main forms of escape from taxation. Number one is tax avoidance. This is a legal strategy where taxpayers minimize tax liability using deductions, exemptions, or structuring transactions within the bounds of the law. Examples is choosing a business structure with lower tax rates or claiming allowable deductions. Tax evasion. This is an illegal act of involving fraud or misrepresentation to avoid paying taxes. Examples are underreporting income, falsifying documents, or not filing tax returns. These are punishable by fines, surcharge, and imprisonment under the National Internal Revenue Code. Shifting. This is transferring the burden of tax from the original taxpayer to another party. Types is forward shifting from producer to consumer, backward shifting from consumer back to producer, and onward shifting multiple shifts in the distribution chain. Capitalization. This is adjusting the value of an asset to reflect future tax liability. Example, lowering the price of a property due to anticipated tax. Transformation, improving production efficiency to absorb the tax cost without raising prices. Example is reducing manufacturing costs to maintain profit margins despite tax imposition. Exemption, this is a government grant immunity from taxation to specific individuals, entities, or activities. Example is non-profit organization or certain government agencies. And then we have tax amnesty. This is a government program that forgives past tax liabilities, encouraging delinquent taxpayers to comply moving forward. Legal framework and enforcement. The Bureau of Internal Revenue enforces tax laws and conducts audits to detect evasion. Legal doctrines like substance over form, business purpose, and step transactions are used to counter aggressive tax avoidance. Impact and incidence of taxation in the Philippines. Tax incidence. This refers to the distribution of the tax burden, that is, who actually pays the tax, regardless of who is legally responsible for remitting it to the government. Legal incidence. This is the party legally obligated to pay the taxes, such as business collecting the VAT. No? Economic incidence. This is the party that ultimately bears the cost of the tax. Usually, they are the consumers. In the Philippines, value added tax or VAT is a prime example. VAT is legally paid by businesses to the Bureau of Internal Revenue. However, the economic burden is passed on to consumers through higher prices. Even if businesses collect and remit VAT, the final consumer bears the cost, making VAT a regressive tax. It affects lower income households more because they spend a larger portion of their income on consumption. Tax impact. This refers to the economic and social effects of taxation on individuals, businesses, and the broader economy. On businesses, we have compliance costs. Businesses must maintain detailed records like file monthly and quarterly VAT returns and manage input and output VAT. Input VAT credits. Businesses can deduct VAT paid on purchases from VAT collected on sales, reducing cascading tax effects. On households, the Train Law or the Tax Reform for Acceleration and Inclusion increased disposable income for many households by lowering personal income tax rates. However, it also raised excise tax on fuel and sugary drinks, which disproportionately affected poor households. On poverty and income distribution, studies using the computable general equilibrium and the micro-simulation models found that train law led to increased household income overall. They reduced poverty incidence, though the poverty gap remained largely unchanged. Statutory taxpayers. In Philippine taxation, a statutory taxpayer refers to any person subject to tax imposed by Title II of the Tax Code, Section 22 of the NIRC. This includes individuals, corporations, partnerships, estates, and trusts that are legally obligated to pay taxes under Philippine law. Types of statutory taxpayers. We have individual taxpayers, which include resident citizens. They are taxed on income from both the Philippines and foreign sources, while non-resident citizens are taxed only on income from Philippine sources. Resident aliens are foreigners residing in the Philippines and are taxed on Philippine-sourced income. Non-resident aliens are taxed only on income earned within the Philippines. Next is we have corporate taxpayers. Domestic corporations, these are corporations incorporated under the Philippine law and are taxed on worldwide income. Resident foreign corporations are foreign entities doing business in the Philippines and are taxed on Philippine-sourced income only. Non-resident foreign corporation not doing business in the Philippines. They are taxed on income from Philippine sources. Other entities, we have partnerships. These are generally taxed like corporations except for the general professional partnership. Estates and trusts, they are taxed similarly to individuals, while co-ownership, they are not considered separate taxable entities. Income is reported by individual co-owners. Key characteristics, legal obligation. The taxpayers is required by law to file returns and pay taxes. Defined by law, the classification and obligations are based on statutory provisions, while subject to penalties is failure to comply can result in fines, interest, and other legal consequences. Tax evasion. In the Philippines, tax evasion is defined as the willful and illegal act of avoiding the payment of taxes that are legally due. It involves fraudulent or deceptive practices intended to reduce or eliminate tax liability and is considered a criminal offense under the National Internal Revenue Code. These are the key elements of a tax evasion. For an act to be classified as tax evasion, the following must be present: existence of a tax deficiency. So, meaning there must be an unpaid taxes that are legally due. Affirmative or willful act. The taxpayer must have taken deliberate steps, to evade taxes and intend to evade. The taxpayer must have intended to defraud the government of tax revenue. These are the common acts on tax evasion. Number one is underreporting income or declaring less than what was earned, overstating deductions or exemptions, using fake receipts or invoices, keeping double books of accounts, failing to file tax returns, smuggling or misdeclaring taxable goods, and claiming personal expenses as business deduction. These are the legal consequences. No? Tax evasion is punishable by fines of up to 10 million, imprisonment of 6 to 10 years or up to 20 years for coordinated tax fraud, surcharges 25% to 50% of the tax due, interest 12% annually on unpaid taxes, and temporary business closure under BIR's Oplan Candado program. These are the defense against tax evasion: lack of intent, good faith compliance, no affirmative act of evasion, and expired prescriptive period, usually 5 years from discovery. However, reliance on an accountant is not a valid defense if the taxpayer fails to ensure proper filing and payment. On the other hand, tax avoidance refers to the use of lawful means to reduce the amount of tax owed. It involves careful planning and compliance with tax laws, such as claiming allowable reductions, exemptions, and incentives. Unlike tax evasion, which is illegal and involves fraud or misrepresentation, tax avoidance is legal and recognized by Philippine courts as a legitimate strategy, provided it does not cross into abusive or deceptive territory. Common tax avoidance strategies in the Philippines. Income splitting. This involves distributing income among family members or entities to take advantage of lower tax brackets. Use of tax incentives and economic zones. Businesses operating in PEZA or the Philippine Export Zone are or under the BOI approved projects may enjoy tax holidays or reduced rate, maximizing deductions and exemptions, claiming allowable expenses such as salaries, depreciation, and business costs to reduce taxable income. Timing of income and expenses. Deferring income or accelerating expenses to reduce tax liability in a given year. Or corporate structuring. Setting up subsidiaries or partnerships to benefit from lower rates or exemptions. Tax exemption. This is a freedom from the obligation to pay taxes granted by law to qualified persons or organizations. It is personal and specific, meaning it applies only to those explicitly identified by law. Types of tax exemption. We have constitutional exemption. This is granted directly by the Philippine Constitution. Example, property used exclusively for religious, charitable, or educational purposes. Statutory exemption, provided by law such as the National Internal Revenue Code. Example are non-stock, non-profit corporations under Section 30 of the NRIC. The Local Government Code, exemptions from local taxes for cooperatives, charitable institutions. And then we have special laws. Laws like the CREATE Act or the Renewable Energy Act grant exemptions or incentives to specific sectors, while judicial exemptions are based on court interpretations of existing laws, but courts cannot create exemptions independently. Who can be exempted? Individuals who, with no income or earning below 250,000 annually. We have the minimum wage earners and recipients of 13 months pay and benefits up to 90,000. Organizations, on the other hand, are non-stock, non-profit educational institutions, cooperatives registered with the Cooperative Development Authority or the CDA, and charitable and religious institutions. Corporations, those registered with the investment promotion agencies may qualify for income tax holidays and special rates. Certificate of tax exemption. To legally claim tax exemption, eligible parties must secure a certificate of tax exemption from the Bureau of Internal Revenue. This involves proof of eligibility, application through the local revenue district office, and regular follow-up to ensure approval. These are the important principles. Strict interpretation. Exemptions are interpreted narrowly and must be clearly supported by law. Burden of proof. The taxpayer must prove entitlement to the exemption, and once granted, exemptions cannot be revoked arbitrarily. These are the rationales behind tax exemption. Promotion of public welfare. Tax exemptions are granted to institutions and activities that contribute to common good, such as charitable organizations, educational institutions, and religious entities. These groups provide services that the government would otherwise have to fund, so exemptions act as an indirect support for their operations. Encouragement of socially beneficial activities. Exemptions incentivize private entities to engage in activities that align with national development goals, such as renewable energy projects, cooperatives, non-profit education, and cultural preservation. Constitutional mandate. The 1987 Philippine Constitution explicitly provides tax exemptions for property used exclusively for religious, charitable, or educational process, and non-stock non-profit educational institutions. These exemptions reflect the constitutional commitment to uphold freedom of religion, access to education, and support for charitable work. Economic development. Tax exemptions are used to attract investment, no, and stimulate growth in priority sectors. For example, is the CREATE Act, which offers tax incentives to businesses in strategic industries, Special Economic Zone or PEZA, which provides tax holidays to encourage foreign investment. Equity and fairness. These are exemptions that help ensure that taxation is equitable, especially for low-income individuals or the minimum wage earners, small cooperatives, and non-profit entities that do not generate profit for private gain. These are the legal and interpretative principles. Strict interpretation. Tax exemptions are construed narrowly and must be explicitly granted by law. Once granted, exemptions cannot be arbitrarily revoked unless by law and with due process, and exemptions are personal and cannot be transferred unless the law allows it. Revocation of tax exemption. This refers to the withdrawal or cancellation of a previously granted tax privilege, either by law or administrative action. While tax exemptions are legal privileges, they are not absolute rights and may be revoked under certain conditions. These are the legal basis for revocation. Tax exemptions are privileges, not rights. Exemptions are granted by legislative grace and are strictly construed against the taxpayer. The power to grant tax exemptions inherently includes the power to revoke them. Sovereign power of taxation. The state, through Congress, may revoke exemptions if deemed necessary for public interest or policy. This is based on the principle that taxation is the rule and exception is the exception. These are the grounds for the revocation of tax exemption. Number one, expiration or repeal of the law granting the exception. If the law or special provision that granted the exemption expires or is repealed, the exemption ceases automatically. Non-compliance with conditions. Many exemptions are conditional. Failure to meet these conditions, like filing of annual returns, maintaining non-profit status, no, can lead to automatic revocation. Material changes in operation. If an exempt entity changes its character, purpose, or method of operation, making it inconsistent with the basis of its exemption, the BIR may revoke the exemption. Public welfare considerations. The government may revoke exemptions if they conflict, no, with evolving economic or social policies. And last, revocation by implication. A new law that contradicts An existing exemption may implicitly revoke it, even without express repeal. Limitations on the revocation of tax exemption. Contractual exemption. If the exemption is part of a binding contract or franchise, it may be protected by the non-impairment clause of the Constitution. The government cannot revoke it unilaterally without violating contractual obligations. Constitutional exemptions. Exemptions granted under the 1987 Constitution for non-stock non-profit educational institutions cannot be dismissed by mere administrative orders. Courts have ruled that such exemptions are constitutionally protected. Example, the BIR issued Revenue Memorandum Order number 20-2013 requiring non-stock, non-profit education institutions to apply for a tax exemption ruling valid for 3 years. Failure to comply could result in automatic revocation of their exemption. The court later declared this unconstitutional, stating that the BIR cannot impose conditions that diminish constitutional tax privileges. A tax compromise is an agreement between the taxpayer and the government to settle a tax liability for a reduced amount, based on either doubt as to liability or financial incapacity. Section 204A of the NIRC. These are the grounds for tax compromise. Doubt as to liability. When there is a reasonable doubt about the validity of the tax assessment. Example is lack of due process, where there is a missing letter of authority or final assessment notice, or assessment issued beyond the 3-year prescriptive period. Financial incapacity, when the taxpayer can prove his or her inability to pay the full tax due. This is given when there is bankruptcy or insolvency, or the net worth deficit or capital impairment, or no other leviable asset. Types of tax amnesty. Estate tax amnesty covers estates of decedents who died on or before December 31, 2017. Tax rate is 6% of the net asset value and grants immunity from estate tax liabilities and related civil, criminal, and administrative cases. Tax amnesty on delinquencies covers unpaid internal revenue taxes such as income tax, VAT, excise tax for 2017 and prior years. Applicable to final assessments, tax cases with final court judgment, pending criminal cases, and withholding agents who fail to remit taxes. Tax ranges from 40 to 100% of the basic tax assessed. Benefits of tax amnesty: immunity from penalties, surcharge and interest, and civil, criminal, and administrative liabilities. Confidentiality of submitted documents and termination of pending cases related to covered taxes. Purpose and impact: this encourages voluntary compliance, cleans, cleanses tax records, boosts government revenue, and provides relief to struggling taxpayers. Double taxation, on the other hand, is the imposition of two or more taxes on the same taxpayer, on the same subject matter, by the same or different taxing authorities within the same period. Types of double taxation. We have the direct double taxation. No? So, same taxpayer, same taxing authority, same subject matter, same purpose, same taxing period, and same kind of tax. A city government imposes two identical business taxes on the same income source. No? And this is generally disfavored and may be challenged as unconstitutional if it violates principles of fairness and equity. Indirect double taxation. These are taxes imposed by different jurisdictions or for different purposes. May involve national and local taxes or income and property taxes. Example, a company pays corporate income tax on profit and shareholders pay personal income tax on dividends received for this profit. Another example is a person who earns income in a foreign country and is taxed there, then also taxed in the Philippines as a resident alien. Legal framework and remedies. There are no explicit constitutional prohibitions, but courts aim to avoid obnoxious double taxation. Equal protection clause and uniformity of taxation principles may be invoked to challenge unfair double taxation. International double taxation occurs, no, when income is taxed in two countries, typically the country of source and the country of residence. Solution: double taxation agreement. The Philippines has signed 43 double taxation agreements with countries like the US, Japan, and the UK. These treaties prevent or mitigate double taxation through tax credit, exemptions, and mutual agreement procedures. Here is a summary of the double taxation. Modes of eliminating double taxation. In the Philippines, double taxation can be mitigated or eliminated through several legal and administrative mechanisms. These are designed to ensure that income or assets are not taxed multiple times unfairly, especially in cross-border situations. Here are the main modes of eliminating double taxation. Foreign tax deduction. Instead of a tax credit, taxpayers may opt to deduct foreign taxes as an expense from gross income. This reduces taxable income but is generally less favorable than a tax credit. Tax-sparing credit. If a foreign country reduces its tax rate, to encourage investment, the Philippines may still grant a full tax credit as if the full foreign tax was paid, because this encourages cross-border investment.